Markets are now pricing in one full cut for September. And if you look closely, markets are actually pricing in slightly more than one full cut in September. We are currently pricing in 1.13 cuts in September. The reason for that is we have a 21.2% chance of a cut in July, which comes just minutes after Jerome Powell says he is not taking off the table the chance of a July cut. This was bullish enough for the bond futures market to potentially start pricing in the highest odds for a July cut that we've ever seen. So far, over the past few weeks, we've seen the odds of a July cut go from 0 up to 10% to 15%, 17, 19%, now as high as 21%. Now, Powell does say that when it came to tariffs, we basically went on hold on our rate cutting regime. So we were in the process of cutting rates. Donald Trump's liberation came, and so we basically went on hold. We delayed more rate cuts because of tariffs. And other countries are also trying to figure out how to respond, because even the Bank of Japan's president suggested, well, we have to evaluate what the relative tariffs are going to be. Is everybody going to be at 10% that the United States imposes, or is China going to be higher than us? And that relative aspect will have some effect on our monetary policy. So in this forum between Jerome Powell, Christine Lagarde, the president of the Bank of Korea, Bank of Japan, and then Bailey from the Bank of England, we find this sort of collaboration of, yeah, we're all trying to get to 2% mandate on inflation, and we're all uncertain about tariffs. But one thing that's really good is so far, numbers are coming out pretty dang well when it comes to jobs. Jobs data has been fantastic. In fact, this morning we had the JOLTS numbers that came out. They came out as a beat pretty much across the board. The revisions were super minor and positive. And when it actually came to looking at the quits rate increased, which usually when we see quits go up, it's a sign that people are more confident in the labor market. We saw a higher opening rate with a lower layoff rate and 7.769 million jobs versus the 7.3 expected. So bullish across the board on JOLTS this morning, which echoes something we saw in the course member live stream this morning when we were analyzing Paychex earnings calls. And in the Paychex earnings call, they went as blunt as saying, we do not see a recession based on current jobs data. Yes, some businesses are going under and some businesses are failing, but broadly, we are not seeing recessionary data. Now, the market today may not perfectly agree with that, but it is very interesting because this morning, something I mentioned is that Robinhood would very likely get rejected at close to $100. And usually what we see with rejection levels is Robinhood or any stock really rejects slightly before that. So this morning, Hood was at $93, and in the Alpha report, we sent out an alert that suggested, hey, this could climb to nearly $100. Look what it did this morning. It went from 93 in pre-market when I sent out the Alpha report to 99.18. And then essentially rejected straight down. So this is essentially your front running of a 100 rejection. And then also Tesla, look at that bounce on 295. So if you're not part of the Alpha report yet, make sure you grab that over at meetkevin.com. There's a lifetime option available. You get lifetime access to the Alpha report, all of the courses on sales, Trumponomics, our big beautiful bill, internal breakdown when that bill passes, what to do as an entrepreneur, productivity, real estate sales, real estate investing, stock investing, you name it, check it out at meetkevin.com. So as far as the ECB forum, Jay Powell also talks about labor, and he says we see a gradual cooling in the labor market, but we don't actually see any sign of a shock yet. Now, this is potentially because of this delayed impact that we're seeing in tariff data, really. Now, one of the things that's remarkable about this is if I pull up the S&P manufacturing report that was just released this morning, you'll find the following. It was actually a pretty decent report. The manufacturing sector expanded again in June, with operating conditions improving to the greatest degree in over 3 years. This is a fantastic manufacturing report. However, we are seeing input costs for companies increase, which suggests that pricing power to pass on prices to consumers might be limited. It also suggests that the costs going into what businesses are paying is rising, which unfortunately is a red flag for company margins and future hiring. Maybe. And here is, I think, the biggest warning. So the chief business economist at the S&P Global Market Intelligence Group, basically they analyze and put together this data, they say that, hey, this is a welcomed return to growth for manufacturing after a 3-month decline. We're seeing rising orders, both domestically and in export markets. We're seeing reviving demand, encouraging factories to take on additional staff at a rate not seen since the end of 22, which is when the chip sector bottomed out. Remember that? This is really good. However, they caution that and say, however, at least some of this improvement has been driven by inventory building, as factories and their customers in retail and wholesale markets have sought to safeguard against tariff-related price increases and possible supply issues. It therefore seems likely that we will get payback in the form of slower growth as we enter the second half of the year. I hate to say it, but this is a very, very clear warning that potentially a lot of the excitement we're seeing right now is hopium that we will end up having some form of punishment for in the future. Now, hopefully not. The data right now says there's no punishment. Again, JOLTS was great, S&P numbers were great, even the ISM numbers were good this morning. This morning we got the ISM numbers that came out, and we had essentially beats across the board. We had ISM manufacturing coming in at 49 versus the 48.8. That's still in contraction, but slightly better than expected. Prices paid came in worse than expected, so higher prices than expected. New orders came in, it wasn't a beat across the board. My memory didn't serve me right there. ISM new orders actually missed at 46.4, and ISM employment missed at 45. So both of those in contraction. So you're kind of getting this mixed data, I guess is the way to look at it. So this is probably because we are in this mixed environment where we got this pull forward, but now the question is, how long is that pull forward going to last? It's a little bizarre. In fact, we can just jump over and look at the report. Here's the actual ISM report that came out this morning. Economic activity in the manufacturing sector contracted for the 4th consecutive month, following a 2 straight month expansion. General, let's see here. Okay, the reading. Let's get to some of the bottom line here. Okay, in June, manufacturing slowed its rate of contraction. So that's actually good, slowing your rate of slowdown. That's a bizarre way to put it. With improvements in inventory and production being the biggest factors. However, and this is actually consistent here with the S&P report, demand indicators remain mixed. So this is where you're seeing kind of like new orders coming in slower, but it's that inventory buildup that has made things, decently exciting. So there's, this mixed talk about a tariff mess. There's some talk about hiring freezes. And you can see the data's really all over the place right now. And I think, erratic trade policy, uncertainty. I mean, these are things we just hear over and over again. None of this at this point is something that we can look at and say, oh yeah, we definitely know what's going to happen. But this warning from the S&P economist does suggest, hey, even though we might have really good, oh, thanks, Jack. You want us to come say hi really quick? Oh, we dropped it. Jack made a video on his YouTube channel of our little trip to Vegas. What's your channel? Meet William?
Meet Jack.
Oh, Meet Jack.
That's my middle.
Oh, that's your middle name. Okay. See ya. Have fun at, what are you going to, school?
Yeah.
Yeah. Yeah. Camp? It's basically school.
Not really.
It's basically babysitting. Yeah. Yeah.
But with friends.
But with friends. Let's go. See you, dude. So anyway, yeah, we're in this environment where you kind of look at this and go, we can't really point to really bad data right now. If you're a bear, you're kind of like, I mean, things, as Jay Powell said, we see a gradual cooling in the labor market, but no shock yet. And I think that's a great way to put it, is we're kind of in this environment where we're shock prone. Like if all of a sudden we had a surge in layoffs, the 10-2 yield spread and the beverage curve, both of those suggest we'll be in a really crappy situation really fast. So we're really shock prone. But if you're a bear right now looking, you're kind of like, can't really point to one thing that's really bad. I mean, valuations are high, but that's probably because data's just been good. You can't really be a bear right now. That said, That's kind of how every recession goes, right? Or we just won't have a recession at all. Who knows? That's kind of the place where we are right now. But I will say what's optimistic is Jay Powell moving up this potential talk about rate cuts. All of them, by the way, being willing to cut rates, tariffs just delaying the issue, and Lagarde actually defending Powell, saying we would all do exactly the same thing as Powell is doing right now. Powell also talks about stablecoins a little bit by echoing Christine Lagarde's talk on private stablecoins. The concern that central banks, by the way, have on stablecoins, and there have been a lot of economic research papers on this. I've read them. They're very boring. It's not worth me pulling them up for you. I'm going to give you a bottom line on it. Central banks are worried about private stablecoins replacing dollars or like whether it's euros or pounds or Japanese yen or Chinese yuan, renminbi currency system, right? Central banks are worried about losing these fiat currencies to stablecoins because it prevents them from being able to print money, right? What's up? Oh, okay. Oh, nice, dude. See ya. That's why central banks want fiat. Fiat gives them the opportunity in a crisis to print money. Remember, folks, people ask me, oh, Kevin, aren't rate cuts bullish for the market? And obviously, you can't look at the market on a day-to-day basis and say, oh, yeah, rate cuts are bullish or bearish or whatever. Rate cuts, in a weird way, they come at during a time of economic slowing. Rate cuts usually don't prop up the market. What props up the market is helicopter money and printing money. So usually what happens is you'll get rate cuts. At some point, then you get a recession. And you don't really get out of the recession until you get the money printing. When the money printer turns on, that's when we flood the economy with liquidity and markets really bottom out and go up. That comes well after rate cuts usually. And so it's a very bizarre situation to be in. But remember that right now, yes, we are shock prone, but the data right now isn't screaming bad. I do, though, respect this warning here that, yeah, if we just pulled forward a lot of the good data, the second half of the year could kind of suck, and congratulations, we are officially in the second half of the year. I personally can't believe it. I feel like this year has run away from me already. Although I did become a jet pilot this year, which is kind of cool. But then again, I'm like, man, it's already July 1st. I feel like the year is just escaping me. But anyway, it's July 1st. We're already in the third quarter. We're already in the second half. So today is the first day of the second half of the year. And it's kind of interesting that on the first day of the second half of the year, the Qs are down 80 basis points. And it's not solely because of Tesla either. Very interesting. Anyway, that's our update on Jay Powell. Oh, and check out the Alpha Report over at meetkevin.com. Sign up and get that lifetime access.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.